Global markets seem to be constantly shifting, and emerging economies are becoming powerful engines of growth. But could they be right for your portfolio? In this video, we're going to take a look at the iShares Emerging Markets Equity Index Fund, a low-cost, diverse way to tap into some of the fastest growing regions in the world. We'll dive into the fund's key features, potential returns, and the unique risks involved, and help you decide if this investment is right for you. Quick disclaimer before we start: it is important to note that this content is for informational purposes only and should be not considered advice, a recommendation, an offer to sell, or a solicitation to buy any of the securities mentioned in this video. With that being said, let's get into it. The iShares Emerging Markets Equity Index, which we will refer to as the iShare EM Index for the remainder of this video, is an investment fund aiming to track the performance of a wide range of stocks from emerging market economies. This fund provides a diversified exposure to companies in countries such as China, India, Brazil, South Africa, and more, providing investors with diversified exposure to the market. This includes a mix of larger and mid-cap companies across many sectors and geographies. The objective of this fund is long-term growth and designed for investors to weather periods of high volatility in exchange for long-term returns. This is an example of a mutual fund, which means it pools the money of many investors to fund the purchase of its securities. These investors will usually be seeking international diversification and growth potential from rapidly developing markets. Now, here's why I think emerging markets are increasingly attracting investor attention and could be a lucrative investment area. First off, according to Reuters, emerging market equities are outperforming their developed counterparts. Latin American and emerging European equity funds have surged to around 24%, countries like Morocco, Colombia, Greece, Brazil, and Portugal exceeding 30% gains. In contrast, US equity funds delivered a modest 0.17% return. Additionally, the MSCI Emerging Markets Index, which is the index that our fund is tracking, is trading below its 10-year average price-to-earnings ratio, which could indicate attractive valuations compared to pricier US indices. Another key reason is that macroeconomic shifts are favoring emerging markets. For example, the US dollar has seemed to be weakened. Following concerns over long-term US debt and fiscal instability, a weaker dollar typically benefits emerging market stocks by attracting global capital which are seeking higher returns. Monetary easing in developing economies and underallocation by US investors, which at the moment seems to be around 3 to 5% versus a 25% global market share, are contributing to the positive outlook for emerging markets. Another key reason is sectoral growth opportunities. Countries like India, Vietnam, and Kenya are experiencing rapid growth in their tech sectors, including e-commerce, fintech, and software services. Africa's energy landscape presents opportunities in renewable energy, with countries like Kenya and Morocco leading in solar and wind power projects. Emerging markets are also heavily investing in infrastructure, with projects in transportation, energy, and urban development. For instance, Brookfield Asset Management plans to more than triple its assets under management in India over the next 5 years, targeting $100 billion. And finally, another key reason is geopolitical and policy support. Countries like Nigeria and Kenya are implementing reforms that improve fiscal management and liberalize foreign exchange markets, enhancing investor confidence. Initiatives like the African Continental Free Trade Area aim to enhance intra-African trade, creating a more integrated market and shifting value from raw exports to processed goods. So, to get started, let me highlight the key features of this fund that we are going to be looking at today. The fund type is an index tracker fund, and its objective is to track the performance of the MSCI Emerging Markets Index, as previously mentioned. The fund's size is around £3.6 billion, and its asset class is equities, specifically in emerging markets. It's managed from the UK under BlackRock, which is under their iShares brand, and is dealt in the currency of Great British pounds. Currently, the ongoing charges for this fund is around 0.2 to 0.3%, and it is important to note that this is very low for a global equity exposure fund. Its structure is available as both mutual and ETF formats, however, the mutual is most common, and its top holdings is Taiwan Semiconductor, Tencent, Alibaba, and Samsung, with over 1,000 other stocks being held. Now for a brief background of the fund. This fund is over a decade old, managed by BlackRock, a leading global asset manager. This is under the brand iShares, which is known for its scale, liquidity, and value offerings in the passive investment sector. It aims to offer cost-efficient access to the emerging market space with a focus on long-term capital growth. It does this through tracking the MSCI Emerging Markets Index, which is widely recognized as the benchmark for emerging markets equity exposure. In regard to the fund's geographical composition, around 70% originate from emerging Asia, 10% from Middle East and Africa, 7% from South and Central America, 3% from non-classified regions, 2% from developed Asia, and 2% from emerging Europe. Now, hopefully you have a grasp of what you could be potentially investing in. Let's get into why I think this fund could be a good consideration for any additions to your portfolio. As of March 31st, 2025, the fund has demonstrated the following annual returns. The 1-year total return was 8.82%, 3-year annualized return was 3.12%, and since December 13th, 2021, it's 1.42%. These figures from BlackRock are based on net asset value with gross income reinvested, excluding entry and exit charges, which were mentioned previously. The fund's performance slightly trails its benchmark, which reported a 1-year return of 9.40 and a 3-year annualized return of 3.52%. However, this trailing total returns graph shows us that across most time horizons, the average fund performance is between 3 and 9%. Also, it outperformed its category, which is global emerging markets equity, in nearly every time horizon too. It is important to note that while at the 1 month, on the far right here, performance is significantly higher, this is likely due to high levels of volatility which are associated with this market. The general trend is that the longer the period of measurement, right to left, the greater the returns on the investment. According to Morningstar, the price return on the fund for 2024 was 13.74%, which is the highest it has been since 2019, showing a positive growth trend in the price of this investment. Now, I want to talk a little bit about diversification. When investing, there are 2 main types of risk. One, systematic risk, which is the risk that affects the entire market or economy, not just one asset. Examples of this would be interest rates, inflation, or a recession. And 2, idiosyncratic risk, which is the risk that is specific to any one company or stock. Examples of this could be a company scandal, management failure, or poor company performance. While we unfortunately cannot control the systematic risks associated with our investments, we can reduce idiosyncratic risks. One method of doing so is through diversification. Briefly, it is the process of increasing the range of investments in order to reduce the impact of a single investment has on total portfolio returns. By diversifying our investments, we prevent idiosyncratic risks from resulting in significant losses because a portion of our money is invested in businesses being unaffected by the same issues. If you're looking to take this investment further, we should consider diversification opportunities. One way we can diversify this investment is by taking defensive assets such as bonds and cash. iShares even offer their ultra-short bond, money market, and global aggregate bond funds for this exact purpose. Bonds and cash are less risky than assets, therefore making them a good complement to emerging market funds to ensure growth through periods of high volatility. If you're looking to diversify further, you could invest in global developed market equities. This ensures that in periods of high volatility, the less risky developed markets can support the portfolio, and you're in periods of global market booms, the potential returns could be far greater than on the undiversified portfolio. Now, while we can aim to minimize these risks, it is important to note that with any investment, besides maybe certain cash or bonds, it is impossible to eliminate all risk, whether that is all idiosyncratic risk or any systematic risk. Therefore, any investment decisions should be made when fully aware of the risks you are exposing yourself to. In the case of the iShares fund, as mentioned previously, being an emerging markets fund means that it is associated with higher levels of volatility than funds investing in developed markets. This is due to the following factors: volatility caused by the political climate, emerging markets are prone to political uncertainty, common shifts in policy that affect the performance of domestic countries and investor sentiment, market efficiency. Emerging markets are less researched than their developed counterparts, causing sometimes unexpected bad news to blindside investors. Emerging markets also tend to have less enforcement and regulation against market manipulations, such as insider trading. Also, the value of currency in emerging markets fluctuate greatly, which can impact the value of investments. Now, the ideal investor profile for this fund, considering its key characteristics, are as such. 1. If you have a moderate to high risk tolerance, this fund can experience significant short-term periods of volatility due to the reasons mentioned previously, making this suitable for investors who can tolerate sharp market fluctuations in pursuit of higher long-term returns. Long-term investment horizons. Emerging markets are prone to move in cycles and tend to underperform for extended periods before rebounding strongly. It's also best for investors with a longer-term growth objective and can afford to weather periods of recession. Growth-orientated goals. Equity-based funds which do not provide stable income measures such as bonds or dividends are ideal for those seeking capital appreciation, such as long-term wealth builders and retirement savers. And finally, diversification-focused investors. This fund is suitable for those who want to explore high-growth regions beyond the typical developed markets. This complements global equity holdings as well as part of a larger portfolio. So, just to wrap things up, the iShares EM Fund offers exciting growth potential, but like all investments, it's not without risk. The key is knowing how it fits into your wider strategy. With broad exposure, low fees, and access to some of the world's fastest growing economies, it's worth considering for long-term investors ready to embrace a bit more risk. And if you found this helpful, please feel free to comment, like, or share the video. Thanks for watching and happy investing.